Paramount trying to outbid Netflix for Warner Brothers Discovery? Just let that sink in.
I don't buy that rumor for a second. Paramount barely has the cash for lunch right now, let alone a massive blocking bid.
Hey, desperate times. But if you want actual money-changing hands, Apollo just dropped $3.7 billion on Japanese glass.
Nippon Sheet Glass. I read the release. Auto glass and renewables, sure, but the valuation makes 0 sense.
Which is exactly why we need to talk about this sudden private equity obsession with Tokyo. The rundown, $6 billion for a mobile gaming studio in this economy.
Savvy is playing with different money, Nate. But yes, ByteDance offloading Moonton for $6 billion is a massive number.
It is absurd. Gaming M&A valuations have absolutely cratered. Everyone else is doing small bolt-ons, and here comes Savvy dropping $6 billion like it is pocket change.
I actually think it makes perfect sense. ByteDance is trimming the fat. They want out of hardcore gaming. Savvy wants to build an esports empire. It is a clean exit.
Clean for ByteDance, maybe? I still say they overpaid by $2 billion. Just look at the Southeast Asia multiples right now. Valuations have dipped across the board. The smart money is doing minority investments.
You are applying standard PE underwriting discipline to a sovereign wealth fund. They do not care about your multiples. They care about market share.
Fair point. Speaking of underwriting discipline, Olympus Partners is cashing out. They are selling the retina business of EyeSouth Partners to Cencora.
$1.1 billion for that one. Cencora is clearly trying to build out a specialty pharmaceutical pipeline.
And they are paying a premium for it. Healthcare roll-ups are still printing money if you exit at the right time.
Which Olympus did. But if you want to talk about real premiums, Gilead just locked down Ouro Medicines for nearly $2 billion.
I love how every biotech target sounds like a Bond villain. Ouro Medicines. We are developing the T-cell engager.
It is actually a fascinating program. First in class for autoimmune diseases. The clinical data in their phase 2 was incredibly tight. I read the trial footnotes last night.
I am shocked. Shocked you were reading clinical trial footnotes on a Tuesday night.
Someone has to. Autoimmune is the new oncology for these pharma giants.
True, but let me pivot to my favorite investor. Uncle Warren is back in Tokyo. Berkshire Hathaway is pouring 287.4 billion yen into Tokyo Marine.
I saw that. What is that in dollars? Roughly 1.9 billion.
Give or take. Buffett just loves Japanese financials. He buys the boring stuff, prints money, and makes the rest of us look like idiots trying to chase AI hype.
It is a massive vote of confidence in the Japanese market, which is the perfect segue, because Berkshire is not the only American heavyweight writing massive checks in Japan this week.
Oh, absolutely not. If you think Japanese insurance is boring, wait until we talk about plate glass. Apollo just dropped $3.7 billion on Nippon Sheet Glass, and the strategy here is wild. The big one. $3.7 billion for glass. Just let that sink in for a second.
Not just any glass, Nate. Nippon Sheet Glass. Apollo is officially making its largest private equity play in Japan ever, and they did it for the least sexy industry on the planet. I absolutely love it.
You always love the boring ones.
Because the boring ones actually make money. Look at the structure here. They're positioning this as a massive play for automotive and renewable energy. Everyone reads the press release and thinks about shiny new solar panels, but if you look at the historicals, their auto glass division is what's really keeping the lights on.
Sure, but you have to look at the macro game Apollo is playing. Japan is the ultimate hunting ground for value right now. Global PE firms are swarming.
True. The yen is weak, and corporate governance is finally shifting towards shareholder returns.
Exactly. Even Warren Buffett is doubling down. Berkshire Hathaway is planning a massive 287.4 billion yen investment into Tokyo Marine. The big money is crossing the Pacific, and Apollo wants a flagship asset to prove they can play in Tokyo.
287 billion yen sounds so much more intimidating than what it actually is in dollars.
Please don't ruin my dramatic banker numbers.
I'm just keeping you honest.
Well, here's my hot take on Apollo's strategy. I give them 18 months before they spin off the automotive glass business. They want the renewable energy multiple. You carve out the legacy car stuff, sell it to a tier 1 auto supplier, and keep the high growth solar glass for a massive flip.
Oh, come on. No way. You're completely misreading the cash flow.
Am I? Auto is a low margin grind.
Yes, but the renewable sector requires massive capital expenditure. Where do you think Apollo is getting the cash to supercharge those green operations? They need the legacy auto contracts. You don't pay $3.7 billion to immediately amputate your primary cash cow.
I'm just saying, if I'm sitting in Apollo's investment committee, I'm looking at how to get a tech-like multiple on a manufacturing asset. Auto glass doesn't get you there.
You're sounding like a pitch deck again. Look at what market analysts are saying right now. Private equity firms are evaluating targets with extreme caution. They're prioritizing strict underwriting discipline over broad market hype. They don't want a tech multiple. They want real, boring cash. Nippon prints money every time a Honda gets a new windshield.
Fine, I'll concede the windshield point. But you have to admit, Apollo's clearly trying to shatter expectations here.
Wow. Did you write that down before we started recording?
I've been sitting on that one all morning. Look, it's a massive statement of intent. They're buying real assets while half the market is still chasing AI dreams.
Speaking of chasing dreams and questionable valuations, I hear there's some absolute chaos brewing over in the media sector.
Chaos is putting it mildly. Wait until you hear what Paramount is trying to pull off with Warner Brothers Discovery just to spite Netflix. Voices. So I was reading this analyst note this morning claiming private equity firms are suddenly treating AI targets with, quote, extreme caution, unquote.
Extreme caution? I'll believe that when the term sheets stop looking like lottery tickets.
No, they're actually prioritizing strict underwriting discipline over the broader market hype. Supposedly.
That's hilarious. Underwriting discipline and AI in the same sentence. But honestly, it checks out. I've read the footnotes on some of these recent AI roll-ups. You can't model a path to profitability when your cloud compute costs are eating your gross margins alive.
Exactly, and we're seeing that caution bleed into geography too. Financial experts are flagging Southeast Asia right now. Deal volumes are up, but valuations have actually dipped. Everyone is pivoting to smaller acquisitions and minority investments.
Which makes total sense. You don't want to buy the whole house right now. You just want a call option.
See, I disagree. If valuations are dipping, that's when you back up the truck. That's exactly what the contrarians are saying about the alcohol M&A market right now.
Wait, you're comparing Southeast Asian tech deals to the booze market.
Stick with me. The analysts are saying alcohol deals have cooled off because of oversupply and shifting consumer tastes, but the smart contrarians see a prime setup for future returns. Buy when there's blood in the streets, or in this case, spilled tequila.
That is a terrible analogy. Alcohol is cooling because Gen Z doesn't drink as much. That's a structural demographic shift, Nate, not a cyclical blip. You can't just buy a distressed craft brewery and pray 20-somethings suddenly discover heavy IPAs.
You underestimate the power of a good celebrity rebrand? I'd absolutely buy a distressed tequila portfolio right now.
Please don't. Keep your checkbook closed, because if you want to see what an actual aggressive move looks like, we need to talk about the absolute chaos happening in the media sector.
Oh, you mean Paramount trying to elbow Netflix out of the way? Spill the tea. Okay, but tell me you didn't smile when you saw the Stripe and PayPal whispers.
I rolled my eyes, Nate. Stripe making a play for PayPal? It is literally a banker's fever dream.
Is it though? Look at the timing. Enrique Lores is packing up his desk as PayPal's board chair. The guard is changing. It is the perfect moment for the ultimate disruptor eats legacy giant narrative. Think of the pitch deck.
I am thinking of the math. PayPal is sitting around 80 billion. Stripe was last valued at 65. You are talking about a startup swallowing a massive publicly traded regulatory minefield.
A very aggressive startup with incredible momentum. Fine, you hate that one. What about Estee Lauder quietly circling Puig?
Now that makes strategic sense, building an unstoppable European beauty giant. I buy that narrative because the data supports the consolidation.
See, you just hate tech rumors, but you cannot ignore the absolute wildest gossip of the week. Paramount supposedly lobbing a higher bid for Warner Brothers Discovery just to keep Netflix away.
Oh, come on. Paramount submitting a higher offer? With what cash? They're practically checking the studio couch cushions for quarters right now.
It is a defensive block. If Netflix gets that WBD content library, it is game over. Paramount is just trying to force Netflix to overpay. It is classic poker.
It is not poker if everyone at the table knows you are holding a pair of twos. Netflix has the balance sheet. Paramount has a mountain of debt. If I am Netflix, I am calling that bluff in a heartbeat.
You are ruthless. I respect it, but I love the drama of a good spoiler bid.
I prefer deals that actually close. Speaking of which, Sony might actually cross the finish line tomorrow.
Right, the TCL deal, $1 billion in the home entertainment space.
Exactly. Let's look at why that matters for the consumer electronics supply chain. Tomorrow's radar.
I'm telling you, Grab is going to regret this $600 million Food Panda Taiwan deal. Valuations over there are dipping.
Wait, Taiwan isn't Southeast Asia, Nate. Geography matters.
You know what I mean. The regional scrutiny is going to be an absolute nightmare. Regulators are already sharpening their knives.
I actually think it clears. But what you should really be watching tomorrow is Sony. They're supposedly crossing the finish line on a $1 billion home entertainment tie-up with TCL.
$1 billion for hardware in this economy?
Hardware pays the bills when it's structured right. But honestly, the rumor keeping me awake tonight is Stripe kicking the tires on PayPal.
Oh, come on. Stripe buying PayPal? That's pure banker fan fiction. Somebody's just trying to juice their advisory fees.
Is it? Enrique Loris is stepping into a new role on the board. The timing is almost too perfect.
I'll bet you a very expensive dinner. We never see an actual term sheet for that.
You're on. We'll check the morning filings and find out. See you tomorrow.